Hi, I'm Stuart Jackson, Senior Analyst at Montgomery Investment Management. Welcome to this week's video insight. Today, I thought I'd take you through our latest thinking on Medibank Private. The company released its maiden full-year profit result last month to a very positive reception from the market. When looking at insurance company results, there are two components to highlight. First, there's what we call the underwriting result. This was the insurance premiums earned less the claims costs and overheads. For fiscal 15, revenue growth was lower than prospectus forecast, but in line with our expectations. Similarly, estimated claims costs as a percentage of the premium revenue, or the claims expense ratio, was in line with our forecasts. The big surprise came from overheads in the business. Expenses fell 1.1% relative to the prior year. Even more impressive than that was the company was able to reduce expenses despite amortisation of customer acquisition charges increasing 135% on the prior year. Adding to the positive surprise was guidance that management expense ratio, or the overheads as a percentage of premium revenue, would fall from 8.8% in fiscal 15 to 8.3% in 16 and then below 8% in 17. This implies overhead expenses will remain roughly flat over the next 2 years. Flat overheads over a 3-year period will drive significant margin uplift, even with only moderate revenue growth, resulting in profit growth that significantly exceeds revenue growth. Margin expansion is also likely to be a source of improved return on capital for the business and improved cash generation. Our core investment thesis was predicated on an ability to improve the efficiency of the business through the tightening of claims costs, procurement savings in leveraging Medibank's scale, and in the longer term, improved efficiencies in patient management through systems, investments, and conjunction with hospital operators. There is the potential to leverage Medibank's scale to analyse care pathways for best practice. We also see the opportunity to offer lower cost product alternatives that access the best and the most efficient providers as an alternative to the traditional policy that covers almost all hospital operators. Such a product would sit alongside full coverage products to offer consumers a broader range of product alternatives. This would be very difficult for small health insurance providers to replicate. This would lead to improvement in gross margins to levels more in line with Bupa. It would also allow Medibank to pass some of the efficiencies onto policyholders through slowing inflation on pricing and premiums. While early signs of good momentum on claims expenses are evident in the result, the added benefit of positive operating leverage from a flat outlook on overheads in the medium term produces incremental upside to our positive investment case. The company faces offsetting pressures from an ageing population, adding to the claims expense cost increases that then drive the need to raise premiums faster than inflation, fueling consumer churn and downgrading coverage. However, as these are factors faced by the industry as a whole, these costs are likely to be passed on to consumers over time. The cost of a consumer dropping out of the private system on the federal and state government budget will ensure that government policy evolves to make the public hospital system as unattractive as possible to those that are perceived to be able to afford private health insurance. The second component of earnings is investment returns. Insurance companies hold investments as prudential backing for their future claims liabilities. We note that around 77% of Medibank's investment portfolio is held either in fixed interest assets or as cash. The company had been indicating that investment returns would be weaker than in the prior year, given lower interest rates. While down on the prior year, it was better than our expectations. In terms of the outlook for investment returns, low interest rates are likely to continue to put this part of the company's earnings under downward pressure. This offset to the good growth in underwriting profits is often mentioned as a reason to be negative on the stock. We would argue that just because $100 will earn only $2 of interest this year instead of $3 last year, that doesn't mean that the $100 is worth less than $100. If you find someone willing to sell me $100 for $80, please let me know. So while there are headwinds in the industry, and with investment returns as well, we believe there is significant upside potential through improved efficiencies and by leveraging scale benefits. Longer term, there is an added potential benefit that Medibank could act as a consolidator in the industry. That's all for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.